studying your last two. I swim med when they turned in. The styrene down to mute. And can learn the pole that sunk he died.
Welcome. In this slide, let's understand one of the most important schedules in a T2 corporate tax return, Schedule 7. Think of Schedule 7 as the corporation's investment income sorting machine. A corporation can earn income from many different sources, but not all income is taxed in the same way. Before the correct tax can be calculated, that income must first be classified into the proper category. Every dollar the corporation earns flows into Schedule 7. From there, it is separated into two different buckets. The first bucket is active business income. This is income earned from the corporation's primary business activities, such as selling products, providing services, manufacturing goods, or operating a professional practice. If the corporation qualifies as a Canadian-controlled private corporation, this income may be eligible for the small business deduction, resulting in a lower corporate tax rate. The second bucket is investment income, also known as passive income. This includes interest income, dividend income, capital gains, rental income, and other income generated from investments. Unlike active business income, investment income is generally taxed at higher corporate tax rates and does not qualify for the small business deduction. As shown in the comparison table, active business income comes from the corporation's core operations, while investment income comes from passive investments. Because they receive different tax treatment, separating them correctly is essential. The key takeaway is that Schedule 7 does not create income, it simply classifies income into the correct tax category. Once this classification is complete, the rest of the T2 corporate tax return can apply the appropriate tax rules. A simple way to remember this is to think of Schedule 7 as the income sorting machine. All corporate income goes in together, and Schedule 7 sorts it into the correct tax bucket before the corporate tax calculation continues. Now that we understand what Schedule 7 does, let's see how it fits into the overall T2 corporate tax return. Think of Schedule 7 as the central hub for investment income. It doesn't work on its own. Instead, it collects information from several other schedules and financial records before determining how that income should be classified and taxed. The first source is Schedule 3, which reports dividends received by the corporation. Dividend income from Canadian investments flows into Schedule 7 as part of the corporation's investment income. The second source is Schedule 6, which reports capital gains and losses from the sale of capital property, such as shares or real estate. These gains and losses also feed into Schedule 7. Another important source is foreign investment reporting, including forms like T1135. Any investment income earned outside Canada is brought into Schedule 7 so it can be included in the corporation's overall investment income calculation. Finally, the corporation's financial statements provide information such as interest income and rental income. These amounts are also transferred into Schedule 7, making it the central place where all investment-related income is gathered. Once Schedule 7 receives information from these sources, it separates the income into two different paths. Active business income continues through the tax return and may qualify for the small business deduction, allowing eligible corporations to benefit from lower corporate tax rates. Investment income, on the other hand, follows a different path. It is generally taxed at higher corporate tax rates and also affects refundable tax accounts, such as the Refundable Dividend Tax on Hand, or RTO. It's also important to avoid some common mistakes. New tax preparers sometimes classify investment income as active business income, forget to include capital gains, miss dividend income from Schedule 3, or overlook foreign investment income. These errors can result in incorrect tax calculations, loss of small business deduction benefits, and even CRA reassessments. The key takeaway is simple. Schedule 7 acts like the central traffic controller for investment income. Information from multiple sources flows into it, where it is properly classified before the rest of the T2 corporate tax return calculates the corporation's taxes. Let's bring everything together with a simple real-world example to see how Schedule 7 works in practice. Imagine a small consulting corporation that earns income from several different sources during the year. It earns $180,000 from consulting services, $8,000 in interest income, $12,000 in dividend income, and $10,000 from the sale of investments, resulting in a capital gain. Altogether, the corporation has total income of $210,000. At this point, all of that income flows into Schedule 7. Remember, Schedule 7 does not calculate new income or change the amounts. Its only job is to classify the income into the correct tax categories. After the classification, the consulting revenue of $180,000 is identified as active business income because it comes from the corporation's normal business operations. This amount may qualify for the small business deduction and can benefit from lower corporate tax rates. The remaining $30,000, made up of interest income, dividend income, and capital gains, is classified as investment income. Since this income comes from investments rather than day-to-day business operations, it is generally taxed at higher corporate tax rates and does not qualify for the small business deduction. The flow diagram at the bottom shows where Schedule 7 fits into the overall T2 tax return. The process begins with the corporation's financial statements. Those figures are adjusted in Schedule 1 to arrive at taxable income. Next, Schedule 7 separates that taxable income into active business income and investment income. Finally, the appropriate corporate tax rules are applied to each category. The most important lesson from this example is that Schedule 7 is a classification schedule. It does not create income, remove income, or change income. Instead, it ensures that each type of corporate income is placed into the correct tax bucket so that the proper tax rates and deductions can be applied. Whenever you think about Schedule 7, remember this simple phrase: all corporate income goes into Schedule 7, and Schedule 7 sorts it into the correct tax buckets before the corporation's tax is calculated.